Well, it's a bear market. I guess it's time to pack up all our things and just go home. Actually, that's not the case. In a bear market, you can also make money as well. You just have to be smart about how you do it. In today's video, I want to give you guys 3 different strategies you guys can use in order to profit from this bear market. These are going to involve profiting from volatility, earning a yield on idle assets, and using options to play the market. I'll leave links in the description below with timestamps, and I'll also leave links to different websites so you guys can check this out and stay up to date. The very first strategy I want to share with you guys is using options. I'll get into it later in this video, but to understand what options are, these give you the right but not the obligation to buy or sell a particular asset. So with the options, you're not actually trading the physical asset. So if I have an option on Ethereum, I'm not actually trading Ethereum. I'm just trading contracts that say I'm able to buy Ethereum at this price by this date. Options allow you to hedge your positions, lower your upfront costs, cap your downside, and, well, they're capital efficient. So in particular, if I wanted to short an asset, what I would need to do as a normal investor is provide collateral on a platform. This can be on like Binance, KuCoin, or you can even do this on a decentralized exchange like Aave, and you would borrow against your collateral. This collateral you then borrow, you would then go out and sell it on the market in hopes to buy it at a lower price at a future date. But with options, it's a little bit different. Instead of having to cough up the collateral in order to buy one of these put options, instead I can pick the price that I want to have the option at, or my put option, and I select the expiry date. So I'm going to select October 14th, and I'm going to select $1,300 Ethereum, and I'm going to buy one of these. This put is going to cost me $104. This put option basically says, at any given date between now and October 14th, I have the right to sell Ethereum for $1,300. And you're saying to yourself, like, why the snap would you want to do that? Well, if ETH's trading at $1,344 right now, and let's say a week from now it's trading at $1,200, well, I would profit in that scenario. My cost for this option is only $104. So $1,200 plus $104, that puts at $1,304. My profit would be about $40. And you can also use their convenient tool, and it basically tells you how this would work. You have a max profit of about $1,200 because the lowest Ethereum can go is 0, and my break-even point would be at $11.95 ETH. So what I want Ethereum for the price to do is go to $11.95, and I will break even. This is because the cost of the option, this is because my put option, the price that I have, minus the cost of the option. So the put option is $1,300 minus the $105. This is how you get the $11.95. Now with options, a couple scenarios can play out. ETH can Giga Moon, and I would be left holding this option. But the good news is my downside is capped. The most I can ever lose is that cost of the option, which is $104. However, if I would have shorted Ethereum and I was on an exchange, I would probably be tempted to put up more collateral. So I already have $1,000 in collateral or $500. I'm going to be coughing up more collateral, and ETH is basically going to infinity, and I'm not covering my short. Options basically forces you and says, hey, look, this is your maximum downside. It's the cost of the option. Now, of course, there are pros and cons to each of these scenarios, especially with options having an expiration date, but just things to keep in mind. Now, on the other side, if ETH just goes way down, well, I'm going to profit from this the more it goes down. If it goes to 0, well, I'm going to profit the maximum of $11.95 because the lowest it can go is 0. So with this option, my downside is capped. I have exposure to the upside, which is ETH going down, and my downside exposure is capped at 104, the cost of the option. Now this is just a simple option. You can also get a little more advanced using something like Dopex or Hedgic, and if you can see here, these are different strategies you can use. If I'm bearish on an asset, I can select bearish, and I have 4 different options. I can do a strip, I can do a bear put spread, and a bear call spread. These are all different. I'll show you an example of what a strip is. Basically on a strip, it's allowing me to profit from both sides, but it's more so leaning towards the bearish side. So what this shows is that my profit zone is going to be between 1213 and 1604. My maximum loss is at the current ETH price. This is more weighed to the bearish side, hence why my profit is hit quicker. And in order to profit from the volatility to the upside, it takes a little more percentage points to get to that. So again, that's why the definition is high profits if the price rises sharply, or reasonable profits if the price rises. Now, you can even use something like a bear put spread, which you don't get a more profitable experience, but you can get it at a lower cost. You can see for 7 days it's only $70, but the maximum profits you can make are kind of limited just based on the strategy. So you can play around with the different tools on Hedgic, and Dopex offers some as well that you guys can play around with. I'll get to that later in this video. Now this is where we get into the second strategy. This is profiting from volatility. You know, the news like the ETH merge, or the news like FOMC meeting, or interest rates going up. You name it. News moves the markets and it creates volatility. But how can you profit from this? Well, with Dopex, you have a thing called straddles. Straddles allows you to take both sides of the trade and profit from this. I wrote a Substack article on this, and this is how you can trade the volatility. As you can see based on this chart right here, with a straddle, I'm profitable if Ethereum goes up in price or down in price. The only time I'll lose is if Ethereum stays at the same rate. And if it's at the same rate that I purchased this straddle, that'll be my maximum loss point, because that's the cost of my option. If you go on Dopex and you wanted to purchase one of these straddles, all you would do is say, hey, I want to go ahead and purchase 10 of these straddles. They don't have any for sale, but you can see each straddle is only going to cost you about $77, which is pretty cheap based on what the straddle can do for you. It's taking on a put option as well as a call option at the same time. And the ROI on this sucker, I mean, a couple of epochs in this month, has ranged from 50% to over 300%. Hang on, I said ROI in 3 days. So a 3-day return, if I invested $100, would now be $400. That's if I had a 300% ROI. Pretty crazy, pretty nuts. But yes, it's actually legitimate and the profits are actually real. This is the straddle option. You would simply just purchase it, and you can use this tool to determine your profitability point. So if I purchase this straddle now around a 1342 price, Ethereum would have to go to at least $1,419 for me to break even. Or it would have to go to at least $1,264 for me to break even. So between the two sides, it's about $80 give or take on the spread. So in summary, with the straddles, you want to use these in times of volatility. So this can be around FOMC meetings, this can be around CPI numbers, this can be around crypto news like the ETH merge, etc. These are great for volatility options when you think the market is going to be volatile, but you don't know what price it's going to be. Remember, Ethereum going into the merge, that was bullish, right? Well, not so much. I guess Ethereum forgot that and they left the boat, and Ethereum is currently down like 30% from its rally going into the merge. Now, the last strategy is delta neutral farming. Now, delta neutral farming involves borrowing the asset that you're looking to farm so that you don't have exposure to it and profiting from the interest rate. The first protocol I want to give you guys an example with is with synthetics. On synthetics, you can currently borrow this coin. It shows 68%, but it actually ranges around 15 to 20%. And as you can see, based on these APYs, that's usually where it averages. But the main reason why this rate is like that is because there's no SNX to borrow. Currently, it's at maximum capacity, hence why it's given that 68%. But I don't see it holding that rate very long. A lot of people are probably shorting SNX. But you can see here on average, it's around 15 to 20%. To arbitrage the yield, all you do is borrow the SNX, well, provide collateral on Aave, then borrow it, and assume it's probably going to be about 20% to borrow this, and then take your newly borrowed SNX and stake it to earn 60%. You're profiting this yield, and also when you stake your SNX, you're going to get SUSD in return. you can then go ahead and take your SUSD and you can provide that as collateral on Aave, or you can put that on Curve, whatever you want to do, and you can earn a additional yield. So it's just yield on yield and it's free. You really don't care if SNX goes up or down, just as long as you're managing your debt, because you don't have exposure to the SNX token. That's what your debt is denominated in. So this would be an example of a delta neutral strategy where you can profit the yield. Now also make sure you understand that with synthetics, if you are opening up the position, you are taking on the debt pool. So if you want to hedge or auto hedge, make sure you swap your SUSD to DSNX, because if the traders are profitable against you, you may be earning that yield, but you'll also be accruing additional debt. But it could work in your favor if the markets are going down, like BTC and ETH, your debt will actually go down as well. So something to keep in mind. It's up to you what you want to do, but you can check out one of my previous videos I made on how to hedge your SNX position if you want to partake in this strategy. Now, another example of delta neutral farming is GMX. On GMX protocol, you can earn anywhere from 20 to 50% in yields. And this would be a delta neutral strategy as long as you hedge your position. The GLP token is the token that you would need to get in order to have this position in GMX to get exposure and earn those yields. These are the current target weights for each of the assets. It's about 50% stable coins right now. So if I wanted to open up this position on GLP, I would go ahead and purchase the amount of GLP that I want and take a percentage of this and hedge Bitcoin and Ethereum. I would need to hedge by shorting 20% of Bitcoin and 33% in ETH. Now, what this would look like is if I was investing $1,000, a 33% short on ETH would equate to $330. And a short position on Bitcoin would be $200 because that's 20%. So I would open up those shorts after I deposit into GLP. Now, if you go back onto GMX, you can see here if you go under the Earn tab, I would be earning 35% paid in wrapped ETH just for holding this GLP position. So I'm happy, this is great, and I'm getting a delta neutral yield for 35%. Now, of course, you need to manage your debt accordingly and make sure you follow the pool weights on GMX and how they're rolling out and how they're moving. That way you're hedging your positions accordingly. I hope you guys enjoyed this video and these 3 different strategies you can use in a bear market and how to profit from it. Again, in summary, it's options, it's using straddles, and it's also doing delta neutral farming. These are not the only ones. I do have some others. You can check out some of the previous videos on the channel, and you can also, and if you want to hear more of the videos, you can subscribe and hit that bell notification as soon as they come out. And let's go ahead and hit you guys with a wisdom one-liner. Proverbs chapter 12 verses 26. The righteous choose their friends carefully, but the way of the wicked leads them astray. Pick your friends wisely, man. You become the friends you surround yourself with. See ya.